recording. So, hi everyone, this is Finance Meets Real Estate. We meet here every Tuesday, 6:30 p.m. Eastern Standard Time. We have amazing guests. We've had over 100 guests so far every week. So today we're having Lance Groth. So he's going to talk about 1031 exchanges. So it's a hot topic in real estate investing. So how to avoid taxes with a 1031 exchange. So this is the topic for today. So he's the Chief Executive Officer and co-founder of Groth 1031, and his entire career has been in the field of 1031 exchanges, working as an exchange accommodator, business development director, and now the CEO of Groth 1031. And so he worked previously, and he previously had his degree in the area of property and contract law, as far as education. So with that, I'm going to pass it on to Lance, and we'll do an pretty open conversation. So if you guys have any questions, feel free to speak up, or you can raise your hand, or you can put your question in the chat as well. So with that, Lance, I'm going to open up for you, and this video is going to be on YouTube as well. So make sure to check our channel, Finance Meets Real Estate on YouTube.
Yeah.
Yeah, go ahead, Lance.
Yeah,
go ahead.
You're asking me a question, or?
Well, so I guess, do you want to so I kind of briefly introduce you, but I guess, do you want to share like with our audience like how you started in the field? Now you did mention you've been like in the 1031 exchanges field like your whole career. If you want to start by first, what is a 1031 exchange? Just for the benefit of our audience, and what attracted you to this field and how you got into the field.
Yep. Well, a 1031 exchange is a section of the U.S. Internal Revenue Code that allows investors to defer capital gains on an exchange of like-kind properties held for business or investment. Now, that is the verbatim technical term, but to layman's terms, it's basically anytime you sell a real estate asset, it's a taxable consequences. Most people don't realize that the government has a ton of incentives to help people kind of defer those things so that, it doesn't freak them out, because it can be a significant tax. There's a ton of incentives to help people avoid those taxes. And the only requirements is that they have to reinvest into the market, at equal or greater in value. So if you just want a really quick example is, let's pretend you and I, we decide, hey, let's go and invest in some real estate. Especially now, because everybody's terrified to keep their money in the bank. Jesus Christ, how did we get here? And we want to invest in real estate. So let's say we invest into a property about $100,000. Give her a couple of years, let's say 10 years elapse, and let's say that property we purchased 10 years ago, we go to sell it and it's worth $1 million. You and I are excited. That's 900 profit. You're ready to cash in. But people just don't realize the moment you sell a real estate asset is probably the largest taxable consequence of your life. So the example is we bought at 100,000. 10 years later, we're selling at $1 million. So what's our profit? I'm asking you, Stefan. What's our profit?
So 100K and $1 million. Yep.
There you go. Making sure you pay
simplified. You mean like the 900K, the no transaction costs or anything? Is that the case?
Yeah. Sure. So we bought at 100,000 and we sell at $1 million. What's our profit?
Yeah, I mean, let's go with 900,000 if we ignore like transaction costs.
No, call it that. It's called a fact. But as soon as we sell it, between state tax, federal tax, what's called our depreciation recapture tax, that's a blended average of roughly 30 to 33%. So on that 900,000, we're gonna have to pay roughly $320,000. We only invested 100 grand. Thankfully, it was a good investment. It went to $1 million. And now Uncle Sam's coming and tell us, hey, here's a $320,000 tax bill. A lot of people will get spooked. But if they do a 1031 exchange, you don't have to pay it. The only requirement is that they have to repurchase a new property at equal or greater in value. Meaning if we sold for $1 million, we just have to go out and find properties at $1 million or greater. And that $320,000 in taxes that we had to pay, don't worry about it. So that's the crux of it.
Mhm. Yeah, understood. But in terms of, so let's say, do you want to go over a bit the requirements for that? Now, I've done few 1031 exchanges myself, and let's say that, so generally there's, and I'm doing one right now actually as well. So let's say there is like a 45-day identification period where you kind of identify your property and other requirements, right? So what is the usual process for doing that?
Well, the first process is you have to call your accommodator the moment you open escrow, meaning the moment you accept an offer, somebody puts out a deposit, you open an escrow, you have to give us a call, because if escrow closes and those funds are made available to you as an investor, taxable consequence, there's nothing we can do. What we do is, as soon as you open escrow, we basically kind of sneak into your contract. We opened up what's called a qualified trust account for you, which has been getting a lot of attention, because if the funds go to you, taxable event, they don't go to your bank account. But if it goes to your qualified trust account, all taxes are deferred. But the funny thing, we've been getting a lot of attention lately is because most bank accounts are FDIC insured, so they're only insured up to 250,000. But because it's qualified trust account and we're insured and bonded, all the money is insured. So we've had people come to us that don't even want to do 1031s. They're just like, can you just hold our money because it's insured and bonded, because all these banks are failing? We're like, no, do an exchange. So the first thing, when you're in escrow, contact us so we step in. Once escrow closes, that's when the two timelines kick in. One, the client has 45 days to identify a replacement property. It has to be in writing and unambiguous. You don't have to be in escrow. You don't need a purchase contract. You can literally go on your computer, find Google, and get an address, a price, sign a document, send it to your accommodator. 45 days, done. The second one is your 180-day. At the close of escrow, 45 days to identify, but then you have 180 days to actually close escrow on this replacement property. That's to get your financing and basically get your name on title. So the two rules that kick in is the 45-day and 180. But just in general, the basic tenets is that, one, does a property qualify? Yes, if it is held for business or investment. So this doesn't apply to your primary residence. Two, the biggest thing people have to think about is it's called an exchange because you're just exchanging the nature of your investment. So if you sell a property for $1 million, you have to own at least $1 million in real estate. You can sell a single unit building for $1 million and then go buy 500,000. Doesn't matter how you chop it up, just as long as your name is on title for as much real estate as you sold. And the biggest things that really kind of put people to the test is, because there's an inventory issue, not a lot of properties out there. At the close of escrow, the client only has 45 days to find a property. It's not a lot of time when there isn't a lot of properties out there. So that has been a big thing for clients. And then the other timeline that kicks in is 180-day. So for people to kind of understand it in the broadest sense, is as soon as you open escrow, give us a call, we step in. Make sure that property that you're calling us for is not your home, primary residence. It's a property that you use to gain income from, business or investment. In order to defer all of the capital gains tax, if you sold for $1 million, you have to own at least $1 million. Once you close escrow on the property, two timelines kick in. You're going to have 45 days to identify a replacement property, then 180 days to actually close escrow on that replacement property.
Mm-hmm. And so now, in terms of like the bigger, the kind of first thing, higher property value that you mentioned, right? So just to clarify for our audience, so that can be, for instance, let's say someone selling a residential condo that they have, and then they invest in a syndication, call it, or bigger like commercial property. And as long as the share that they're purchasing in that syndication is greater in value than the kind of small residential property that someone is selling in a simple scenario, like, is that the case? Or are there limitations to the type of projects and ownership structures one can invest in?
Yeah, there's a few limitations, especially when you bring up the word syndication. Syndication is normally guys who will take a LLC and they will go and buy property, and they want investors to come in as investors. And then they allow the investors to become basically a member of the LLC.
Right.
And then the LLC owns the property. That doesn't work.
Because
your name has to go, the name on the sale property has to be the name of the replacement. So syndications just do not work. But TIC structures, which are short for tenants in common, DST structures, which are basically just trusts, those are typically apply where somebody will get a big, they'll buy a big property and they'll sell fractional interest. That works. Our focus is great. You can go on to a TIC or a DST or, with multiple investors just as long as you own as much real estate as you sold. So if you sold $1 million property and some investors saying, hey, I have this $100 million property, I can put you on for 10%, which is $1 million, that works as long as your name goes on title. But if it's a syndication where they're like, hey, I own this property in an LLC, we can put you on for 10% as a member owner. The LLC owns it, but you're just a member. That doesn't work. Your name has to go on title.
Right. Yeah, that makes a lot of sense. So the sponsor has to be willing to kind of carve out a separate TIC structure for you, essentially, right? And kind of like have your name on title and that way. And understood. But in terms of like what are allowable property types? Now, my understanding, just as a layman kind of user of, like customer of 1031 exchanges, has been that it's pretty broad, right? It's a like kind exchange. So you can 1031 a condo into I believe, let's say a self-storage commercial property would qualify as well. So it's a pretty broad qualification of what constitutes real estate, or I guess maybe real property in that case.
Yeah, so a lot of people, because the term is you're exchanging into what's called like-kind property, and a lot of people think that's a limiting factor, as in if I have a 3-unit building, I have to go to a 3-unit building. If I have a office space, I have to go into an office space. But that's not the term like-kind is very liberal, very broad. The term like-kind refers to the first rule is this property held for business or investment? So it's just like you can't go from an office space to your primary residence. You can't go in, because the like kind refers to the intent. Are you selling a property held for business or investment? And are you purchasing a new property held for business or investment? If you satisfy that, then you're good. So that means you can go from an office space to a multi-unit building to a plot of raw land to a farmland, just as long as you're not changing the usage, as in property held for business or investment, to your primary residence, because primary residence has a whole separate set of rules. The actual rule for primary residence is called a 121. But if you're a real estate investor, most people know that as a homeowner's exemption. So 1031 specific for properties held for business or investment, and primary residence is a 121. So when you hear exchanging into what kind of property you can exchange into, any properties that you plan to utilize for business or investment.
Okay, that's clear. That makes sense. And because primary residence would be under 121, you were saying, or something like that.
121, homeowner's exemption. If you lived in a property out of the last 5 years and you're single, any profits that you have up to 250,000 completely exempt. And if you're married, 500,000. So that's a separate set of rules.
Got it. Okay, Scott, go ahead. I see you raised your hand.
Hey, yeah, I just had a question about the land. So you mentioned that you can use these funds to purchase land, and that's pretty awesome. I wasn't aware of that. I've only done this once before, but my understanding was that you needed to use the funds to purchase basically another rental property or something that you like. I sold a residential rental, and I tried to buy an office space that was also a rental, and I knew that would be fine. But how does the land work if you were to use the funds to buy land? Do you need to develop it? Like, are there additional rules like that in place?
Not at all. I had a client, our main offices are in San Diego and now in, look at it, check it out. And now in New York. Oh my God, it's lovely. Love it. And, when you're around major metropolitan areas, like in San Diego, for instance, San Diego is getting an injection, which is a great investment tip, by the way. San Diego has a Seaport Village, and they're getting $2.2 billion renovation of this entire area. This is hotels, parks, coming up, all this crazy stuff. So if you bought just raw land in the area right now, knowing that in a couple of years, because this new development's coming, your property is going to increase in value, that is an investment. The exact wording of the rule is properties held for business or investment. So if you purchase a plot of land as an investment, knowing that that plot of land would appreciate in value in a couple of years, that's an investment. That works. Simple and plain. Funny enough, even here's the one we've been encountering a lot lately because of COVID. Do you work from home now?
Yeah.
You sell your house, whatever portion that you like carved out for, this is my office right here. If you sell it, they will take the square footage of that. Like, hey, that portion of your house is now held for business or investment.
Nice.
You're welcome. That will be $500. You can just Venmo me.
Deal.
Put my cash app up.
But
Seriously, man, it's a lot of people get that confused, and it's a very liberal term, especially right now. Like it's the only time we've ever, like the 45 days, the main reason 1031's exchanges failed because it's such a short time. And the only other time we've had an extension to the 45-day was in COVID, because the rule is the only time you can get an extension if there's a presidential disaster where the property lies. And that's typically where there's like a storm or a national emergency, and COVID was a national emergency. Because there were so many rainstorms in California, entire California now has their 45 days extended to October 16th. And honestly, that's just the government's way of trying to give people more time to invest, because of all the economic turmoil. But this whole, when it comes to what properties you can invest into, it is so broad, just as long as you're using real property for business or investment.
Just a question to that, actually, Lance. So in terms of, so you mentioned like investment portion, but your investment portion has to be in a separate title. So to say, you cannot have, let's say, an owner-occupied multifamily, owner-occupied four-family, and it has 3/4 investment portion, but that's not gonna be a viable 1031 exchange, right?
Yeah, it'll actually be
the title is, or sorry?
It'll be both. I just did an exchange for a client, 2-unit. He lives in one unit and he rents out the other one. So when he sells, 50% of his capital gains, he can use a 121 homeowner's exemption, and the other 50 he can defer under 1031. Do it all the time.
Okay, and then when you're transferring into a new property, respectively, you can transfer into an owner-occupied multifamily.
If you're transferring into a new property, same example. Let's say we sold a piece of property for $1 million, 2-unit building. 50% is I live in. The other 50% I rent out. $1 million. That means for $500,000 I have to buy a property for business or investment, and then the other 50% I can use a homeowner's exemption to completely.
Right. But from a title perspective, those 50% that are invested, the investment portion, can you 1031 them into another 2-family that has 50% 500K plus investment portion, and the other one is owner occupied? You can, is what you're saying.
Just as long as the property, the portion that you sold, that is business or investment, when you reinvest it, the value of that is of equal or greater in value.
Okay, understood. Yeah. Okay, I actually didn't know that. I didn't know you can do it with owner occupied multifamily.
My Venmo, send it over. That's what we charge an hour.
That's cool. Yep. Okay, that's great. And so do you want to go a little bit over the identification for a property? Now, I've heard there are two rules, right? There's a 3-property rule. So you just have a list of 3 properties. That's it. If you don't ultimately close on either of those 3, your exchange is kind of done, right? I mean, it's unsuccessful, so to say. Now, there's another rule that's usually harder for me to understand, at least. It has like 5 properties and some kind of mix between them and so forth. So you want to go over that a bit?
Yeah, so once you close escrow, your identification periods, I mean, you have 45 days to identify your replacing property. The 2 typical ways people utilize them, first one's called the 3-property rule, and the second one is called the 200% rule. Now, the 3-property rule is the most commonly used one. I mean, you have 3 options, and there's no limits on your valuation. So remember what I said. You have to own as much real estate as you sold to defer 100% of your capital gains tax. So if you sell a piece of property for $1 million, under the 3-property rule, you can identify 3 properties and it does not matter how expensive. So I sold a property in California for $1 million. I identified 1 property in Florida for $2 million, another property in Texas for $9 million, another property in New York for $50 million, whatever. Just as long as when it's all said and done, you own as much real estate as you sold, but you only have 3 options. And I always tell people, use all 3, because people sell and they'll like get gung-ho on a property, like, oh, I know the buyer and I know the seller and it's great, he loves me, I already got it approved. After 45 days and it fails inspection or this, if you didn't identify something else, you pay your taxes. So use all 3. But let's say 3 properties isn't enough, because what we commonly see now is there is a bit of a mass migration out of major metropolitan areas. So you think about it during COVID was like, hey, if you're in a major metropolitan area, by the way, stay away from other people. So all these people from these big cities are now flooding these rural areas like Florida, Texas, and Las Vegas just blew up because more land, cheaper, less taxes. So what happens is people, sell $1 million property in California, and they can buy a bunch of smaller properties for $100,000 in Texas. So if 3 properties is not enough for you, you can use what's called the 200% rule. And under that rule, you can identify an unlimited number of properties, provided that the aggregated sum doesn't exceed 200% of your initial sales price. So under the example we use, if you sell a piece of property for $1 million under the 200% rule, you can identify as many properties as you want, just as long as when I total it up, it does not exceed 2 million, because 2 million is 200% of 1 million. So the first rule, 3 properties, you're limited on how many you can identify, but you're not limited in your valuation, expensive as you want. Okay, 3 properties, I need more. Great, go over to the 200% rule. Identify as many as you want, but you're going to be limited on the valuation. It can't go over 200% or whatever you sold for. Make sense?
But in terms of, it does, yeah. So in the second scenario, so you're saying you're selling $1 million worth of real estate. You can have as many properties as you want where total sum of the value is $2 million, right? That's the second route, right? In that second route, suppose you identify 10 properties, each of them is 200K. And on how many of those you need to actually close for your exchange to be successful? All of them?
You just I want to say successful. It's just, you just need to own at least, if you want to defer 100% of your capital gains, you need to stick to the same original rule. You need to own as much real estate. So you're going to go to 2 million. All you need, as soon as you hit 1 million, 100% of your capital gains is completed.
Okay, understood.
Give you a further kind of explanation. Let's say we did sell it at 1 million, and we're using the 200% rule. We're buying in, let's say, increments of 100,000. So we're buying a bunch of $100,000 properties, going to 200% rule. So we identified 9 $100,000 properties. That means 900,000 will be completely tax deferred, but because we fell 100,000 short, we're going to pay taxes on that 100,000 we fall short. That's called a partial exchange. Does that make sense?
Right. Yeah, that does make sense. So if you could end up essentially purchasing less than 1 million value, and you would just pay a portion of the tax, right? So you would do a partial exchange in that case.
You'll have to pay 10% of what, because in that you'll have to pay 10% of what you originally happen to pay. But if you hit 1 million, then 100% of your capital gains will be completely tax deferred.
Right. But essentially, let's say in the scenario that you're selling 1 million worth of real estate and you identify 10 200,000 properties, which meets like the 200% rule in that case. And if each of them is each of them is, let's say, exactly 200,000. So you would be able to close on any combination of 5 within those 10.
Absolutely.
Right. So that's pretty flexible in that sense, right?
They're trying their best. I mean, 1031 is meant to stimulate the economy, and right now they can use all the help they can get.
Right. Now, in terms of like another question I have, in terms of like the like kind exchange and, exchanging into another real estate property. Now, does it matter? How do I put it? If it's a property that closed earlier, so suppose, so I have a commercial property. So I'm now doing a real example, okay, perhaps for, so I'm selling I just sold a condo. I'm doing a 1031 exchange on it. Okay, so I have a commercial property. I can carve out for myself a tick inside that commercial property, or am I able to carve out for myself a tick after closing and then 1031 into that tick for a property that already closed before? Considering that that tick is kind of essentially creates new real estate, right? So and then that happens with the 45-day period and so on and so forth. Because my 1031 agent said that sounds doable, but I don't know, like, what's your opinion? It's
A little complicated. So you're selling a piece of property as a tenant in common?
Yes, so selling a piece of property owned by myself only. So
Myself only.
yeah, myself only.
You're going into a
into a tick from a commercial property, but the commercial property closed, let's say 6 months ago. But the tick would be carved out now, so there would be a new ownership.
Your property can close 6 months ago, but when you talk about you're buying into it, your name isn't on title to the property yet, correct?
It would be, if a tick is created, it would be my name on title. So if I carve out a tick, then
exchange to a property you already own. If it was a tenant in common with 10 other foreign investors, people that aren't related to you, absolutely, you can exchange into there. The only thing I would say, hey, make sure whatever you're exchanging into, that portion of ownership is equal or greater to what you sold. But if your name is already on title to that piece of property and you're trying to acquire more ownership interest, you couldn't do it.
No, that's what I'm trying to say. So it's that property is a syndication. So let's say, I guess my question is, I don't want to make it personal. It's just the question is like, can you 1031 into a syndication that closed earlier via the tick structure? That you would
remember what I said about syndication.
About which part?
It's a syndication. Remember what I said about syndication. Syndications are completely invalid because of the fact.
Understood, but tick syndication.
Yeah. So ticks, that would absolutely work if you were not already a title holder to the property, because you can't purchase into property you already own.
That you are not, okay, so you should not be a title holder there at all, basically. Okay, understood. So
you were not, there's like 10 other investors on a piece of property, and one of them it already closed, they bought it, and they're like, one of them says, hey, listen, someone out of this deal and you want to buy their ownership interest, completely doable. But if your name's already entitled to the property and you have, I believe it's about a 31 or 33% ownership interest, you couldn't buy into that.
Okay, but if you have a very minority interest that is in a bigger syndication, you could do it in that case.
Absolutely, anything under 31%.
Right, which I thought it's an interesting option, because it's just essentially you could, in that case, 1031 into something that closed in the past, which is not common, right? I mean, I guess, but right, okay. And then in terms of, so I guess, let me think, what else? So I've had like few weeks ago, I had like a cost segregation guy here. So have you guys had, right? So let's say, what is your relationship like? Do you see it as a kind of symbiotic relationship you guys have with cost seg? Is it something that's
cost seg
driving more customers to 1031 sometimes, or is it something that people try to sort of use it to kind of, instead of using a 1031, but then down the road ultimately they still need to pay the taxes, they sell the property and so forth? But
cost segs typically steps in with 1031s when 1031 exchange clients fail, when they don't identify in the correct time, or they failed at 180 because cost seg typically fails, steps in when the 1031 exchange failed, and basically they're like, hey, your 1031 exchange failed, we're gonna analyze this property, take all the depreciation up front, and we're gonna use that to offset your original capital gains. So the only time we've seen cost seg step in is when the 1031 exchange fails.
Understood. Okay, got it. So that makes sense.
They're just ridiculously expensive.
That's true. Yeah, no, no.
Land survey for those things are like $10,000.
Sometimes I know that's true. Yep.
Yeah, we charge like a flat fee, $12.99. Okay, we got you. Don't worry about it. Here's the information. Here's the paperwork. We'll set up a qualified trust. Money comes to us. Find a new property. Great. Here's all the documents. Send us the wire instructions. Wire the funds. Done. Cost set is like they have to get a
Expensive,
land
yeah.
surveyor, come there, check out the whole property, get all that, and then use all your
Yes.
depreciation. That thing is
Yeah.
expensive.
Understood. And your fee, that's for any selling of any property value. It doesn't matter if it's 500,000 or if it's $10 million. It would be the same, $12.99 or whoever you mentioned your fee essentially in that case.
Exactly.
Mhm.
Right back. Sorry, just letting my client know. I'll call him right back.
Okay. Do you guys have other questions? I took a few questions myself, so I just want to make sure. If you want to raise your hand.
Yeah, a lot of questions. I feel like you're using all my free consultation time.
Yep.
You're like screw listeners. Anyway, Lance, listen, I got a property.
Yep.
You're like, no,
Let me see.
how did I got you on here?
Okay, Scott, go ahead.
I guess I'll ask another. So this is awesome, by the way, Lance. Thanks for being on here. So could you just speak a little bit to the process of basically 1031ing for the rest of your life? Like at this point, I haven't gotten there, but I've heard of mentors of mine and people who are much older and wiser who have basically 1031 their entire life, and they plan to continue to do that till they die. So could you explain just like that concept as that, like why people do that and kind of how it works, like the logistics?
Simple. People don't have a proper understanding of money. Like you look at what's going on right now. My biggest fear with this market is that the banks really messed up when they failed. That's the simplest way I could put it. Like out of every institution, the banks should not fail. And it wasn't a failure, like 2008 was a failure of greed. We created securitized assets for, bundling mortgages, and it was just pure greed. And it was like, yeah, we messed up. But this one was, who the hell fell asleep at the wheel? Because once the failures happened, it was the first time I turned on the news consecutively, and the conversation was about fractional reserve interest. Now, I'm telling you right now, stuff I learned in law school, I was like, why the hell is this information locked up in a $250,000 degree? Everybody's going to own an apartment. So many people are going to own a home. This should be part of public information. And people, it's sad to say, people think when they put their money in a bank, I don't know if you ever watch DuckTales, old 90s kid, they think their money's in there and Scrooge McDuck is just swimming around in gold coins. It's like, no, dude, like your money, if you give them $10, they only have to keep $1, and then 9 of your dollars, they get to loan out. And now that conversation is happening, and banks have lost their number one asset, which is trust. Because once that first bank fell, that conversation started to happen. So people are like, whoa, banks are loaning my money out. Let me get my money out. So next bank, it was Silicon Valley, then Signature, then Credit Suisse, then First American. Oh my God, if you know how many freaking wires I've sent to First American, I'm like, who failed? What? So the conversation about banking system has got people spooked. So many people start pulling their money out. And when you hear people exchange, it's because smart investors know I'd much rather keep my money in a physical asset like real estate. Why? Because it's land, which has always been the number one creator of millionaires, because it's land. They're not making any more of it. And people keep their money in land. So when you do an exchange, here's an example. Like the example, we purchased at 100,000. We sell at $1 million. That's 320,000 in capital gains that we would have to pay. We do an exchange, deferred. Next property, that's just deferred. So that new property, that tax is still on there. So that new property we bought at $1 million, let's say it goes to 2 million, another 300,000. That's 600 total. Deferred. You just keep building it up, building it up, building it up. It's there. If you ever sell and you do not do a 1031 exchange, every single exchange that you defer, you will have to pay. But should you pass away and you hand that property to your heirs, all of those taxes deleted, gone. It's just smart investors understand when you do this, it's okay, I need money. Don't go and sell the property. Do a HELOC, pull the equity out, because you only have to repay it when you sell it and a buyer gives you money, and you can just keep deferring. And if you need money, you can pull that money out in your equity. So smart investors, they will keep doing this for a lifetime because they feel way more comfortable with their money invested in real estate rather than sitting in a bank or banks to go and loan out on their behalf rather than your interests.
Right. And that kind of the thing you mentioned, the HELOC thing, ties pretty well with the whole issue with the fractional reserve banking and
Don't
that,
even be started, bro.
it,
That's a whole nother segment. That's
yeah,
a whole
you can
nother-
just, you don't need to have your whichever funds you live on, you don't need to have them in a bank anymore. I can tell you.
I'd much rather have my money in real estate than a bank
Right.
right now. Like 1000%. Much rather have my money in, you know, if I ever need it, the banks, they'll, hey, I need to post. I purchased this property at $1 million. I put 500 down. That means I have 500 equity. And in a year, apparently it's worth 1.5. So now I have $1 million equity. You know, if I sell this property right now, somebody's going to give me 1.5. So I have to pay back that HELOC or that equity I pulled out. So no problem. I can just pull that money out. Much rather have my money invested in real estate than sitting in a bank.
Right. So with the 1031 exchange, so one, I mean, or with investing in real estate and using 1031 exchange and other tools, once it's tax efficient, and two, you kind of avoid the control issue of having to put your money in a bank and so forth, and yeah, and that also pays you extremely low interest rate and that. So I can just no personal finance advice. That's what I do actually. I'm invested only in real estate, and everything I need, it's lines of credit. Everything is debt, is equity, lines of credit of different sort, or business lines of credit.
About 50, I'm like 50,000 liquid, and
Right.
I own 19 properties.
Exactly. So yeah, that's
No, thank
kind
you.
of debt is tax free, and you have control over your properties, and it's kind of like this type of your own structured personal finance system, right? I guess it's probably ties to whoever reads business books like Rich Dad, Poor Dad, etc. Which I
Yeah, man. It's terrifying. I know it's terrifying now. People are like, I got friends like, Lance, where the hell can I put my money in? A shoebox? I'm like, I don't know, bro. Just stay out of those banks.
Right. Okay, so interesting. So now with this situation again, like this kind of banking crisis, if you will. So you mentioned some people come to you as kind of they just want to use your the protection of the qualified account that you guys have. But so are you seeing a surge in clients, or are you seeing a decline in clients, if you will, from on one side lower transactional activity, on the other side people just want to use you as a form of bank?
They just want to use and abuse me. God damn it.
Right, but then it doesn't exchange. Right?
No, there's a significant slowdown because of the rising interest rates. Like,
sure.
Honestly, with that last one, I was like, sheesh. Like I for the first time in my life, I felt sorry for banks. It was like, I don't know if you guys are doing this, because apparently their investments in those treasury bonds are just getting completely outpaced by this astronomical rise in interest rates. And two, it's just how do I explain this? Yeah, it's just harder to buy property because of that rising out. We were at a year and a half ago, we were at zero, percent. Now we're at like what? It's insane that we're at right now. So it's just harder for people to buy property. So people are buying less.
Right. Yeah. And it's significant credit tightening already as well. Over the past.
Quantitative easing is what the Powell chairman calls it, which is a very fancy word for, you know what? When we sent you guys all a check during COVID,
All right. Yeah.
pull some of that back. You know, that drink that used to cost $5 now costs 26. Yeah, that's quantitative easing.
Mm-hmm. Yep.
Pull it back.
Yep. So yeah, that was definitely not worth it, right? Those
I
seemingly.
know. Why don't you just tax the corporation? Tax me to the bar.
Right. So yeah, it's interesting. The whole redistribution of wealth of that, right? I mean, it's huge. It's like huge redistribution of wealth.
Yeah.
But okay.
Yeah. I look at it as this is our, you know, we all seem to be roughly around the same age bracket.
Yeah.
I look at it, this is our, you know, this is our plot to our story. This is our generation's obstacles. And all about, it's just about like, people can't afford to be, you know, when people say a 1031 is a tax loophole for the rich. That's all, tax loophole for the rich. No, anybody can do it. It's a tax loophole for the informed. So in this generation, you know, especially given the fact that we have access to the internet, we have access to so much information. It is, you know, see what you're doing right now. This is what people need to be doing. People need to educate themselves. Like I had to go to law school and sit there for 3 years and cut off my life to obsess about this information. And you know, I can share it. And people need to share information. People need to get educated. People need to be sharp. It's even with the banking situation, like people need to understand what fractional reserve interest is. You can't just, oh, I put my money in the bank and I trust them, it's fine. No, why the hell would you trust them? Like everybody needs to be sharper, smarter, and more informed, because it's the economy is starting to show like there is no room for error. Like we are always teetering on the brink of a depression. We are that bank SVB's failed and the government stepped in. One, I was like, for all my Republican friends who love talking shit about communism and socialism, I didn't hear much crying about government backstopping a bank. That sounds like a form of socialism right there, pal. You know, so it is, there's no room for error. People need to be smarter. They need to be sharper. They need to be educated. They need to not just trust that the system processes in place are working in the best interest, because honestly, sometimes it's not. Sometimes it's screw you over. Like you have to, don't just take information at face value. Sit down, find an expert who lives and breathes this information and ask them everything and learn this stuff, because it really is just not a lot of room for error.
And that's where I feel, at least my view, I feel like real estate investing is great in that you can sort of practice your own Wall Street, and the reason why you can do that is, okay, it's a form of private equity, but it's the simplest private equity. There is no simpler one that you actually need less business knowledge to operate. It's just the simplest business out there. The valuation is relatively clear, so you can actually operate, and you can sort of simulate Wall Street returns for yourself. Then you can do like some of the things you suggested to kind of be exposed to the bank.
As soon as you mentioned Wall Street, I think I tried investing in stock for like 3 weeks. I lost like 5,000. I was like, I'm done. I don't get this. I'm good. I'm gonna go back to the basics. And with me, no matter how complicated things are, like I'm that guy in law school. I was that guy in front of the class. Like, I don't get it. I don't get it. I don't get it. I need things to be, I need to understand things, and I need to understand why they are. So stocks are a little too complex for me in terms of, I don't know, a tweet could change the valuation on, it's too much. I stick to real estate because I can physically see that property. I can touch it. I know how much I bought it for. I know how much money I put it, how much work I put into it. I know what raises its value. I try to keep things very simple, no matter how complex. You know, Einstein says it best, as the most complex formula it's invalid if you can't explain it in simple building blocks.
Right. And so yourself, so you mentioned you have like 19 investment properties, right? Or yourself, you're a real estate investor as well, right?
Excessively.
Yes, you're right. And so you, so in that sense, like you do 1031 exchanges for your own properties, presumably, or are you more like
So we do a 1031 exchange. Literally, we're called qualified intermediaries. And to be a qualified intermediary,
No.
you cannot be a party to the transaction. So, like when you do a 1031 exchange, people think people do it. No, they partner with guys like me on the back end. They think
I see.
people do it. They part. So I can't do an exchange for myself.
Right. But could you go to another qualified intermediary, like another 1031, exchange agent, essentially?
I'm friends with all of them.
Okay, so
yeah, I'm always, I'm the youngest in the field. I'm typically, as an owner, I'm the only one with this complexion that owns one. So I'm always at conferences and I partner with everyone. And I've been kind of notable for using things like AI, Facebook targeting, Google. Like the vision of our company literally reads as to provide an expert level of service through efficiency, transparency, and above all, compassion. Compassion is because everybody's stressed when they're selling a property. We try to hold their hand, but the biggest thing is efficiency. And I try to use every technological advantage to help clients. Like as soon as escrow closes, within 2 weeks, if a client has identified, automatic email goes out. Within 30 days, if they haven't identified, automatic email, and then a message comes to my team to call them. And if they haven't found properties, we connect them to all people with off-market listings. That's DST, tick investors, people you can't find just by Googling. Like, hey, if you can't find properties, apparently you're looking for this in this state, looking for this return, why don't you go and talk to them? So we try to add a higher level of efficiency to the whole space because the entire legal area is always slightly, older, archaic. So if you we're like, hey, you guys do know there's an app for what you're doing. We try to bring a little bit of youth and efficiency to the whole space.
Right. And so is there anything that we're nearing like the end of our hour here today, let's say. So is there anything we didn't cover, like that you wanted to mention that you find like your clients often miss or that is essential for people to know?
Yeah, number one thing, call us as soon as you open escrow. When you open escrow, you open your exchange account. But yell that. Don't make me make that call. If escrow closes and we are not involved, that is what's called a taxable event. The moment that money hits your account, it goes to the client instead of going to the client's qualified trust account that we set up. That is a taxable event. I can't tell you about the horrendous calls I've had to make because the agent who doesn't understand how it works, like they'll call me like, hey, Lance, listen, buddy, we just closed on this property. Yeah, we're ready to do a 1031 exchange. And I'll go, what do you mean closed? They're like, yeah, we closed, ready to do exchange for new property. Said, as in closed escrow? They said, yeah. So the client has the funds? Said, yeah, we're ready. So I can't do anything for you. And the last time I had to make that call was about 2 weeks ago. The client just had to give them the bad news that they had to pay 1.7 million in taxes. And that's a tough call to make because had they called at the right time, they would not have to pay that. They would have a lot more money to go and buy new property. So always give us a call the moment you open escrow. And our number is simple. I'll put it in the chat. It is 619-991-1031. Really simple. 619-991-1031. Our website is growth1031.com. But the biggest thing is give us a call. The moment you accept an offer, which means you're about to open escrow, you open escrow, when money's being transferred, call us, because if that money is made available to the investor, that is a taxable event. I cannot do nothing. Once that money hits the account, the best thing I'll tell you, call the call seg guys.
Yep, that's true. Yep. Okay. Any last questions, guys, before we wrap up for today?
Personal. Office. 991-1031. My personal on here in case you guys want to call me first. 0-4-5 website. Boom. Whoa, 1031.com. Call me anytime. My girlfriend absolutely hates that, but hey.
Great. Okay, so that's the best way for people to reach you, right? Your phone number, your website. Are you on LinkedIn as well?
Yes, I am.
Are you on LinkedIn or other social media?
Everywhere.
Everywhere.
LinkedIn, YouTube, Facebook, Instagram. Oh, should probably put all that stuff on. Instagram, G is at my name, Lance. Or the company's G at 1031.
Okay, so at Lance Growth on Instagram and at Growth 1031 on Instagram as well.
Yes, sir. Same thing for Facebook. It's a personal page and company page. Same thing with LinkedIn. And YouTube, same thing.
Great. So thank you so much, Lance, so for sharing all your knowledge, answering our questions. It was a pleasure to have you here today.
Anytime, brother.
Appreciate. So this is going to be on YouTube tomorrow. So
All right, man. Hope to hear from you guys. Call me anytime you guys have questions. Seriously.
sounds good. Thanks a lot. Have a good night, everyone.
Sure.